I want you to imagine a specific Tuesday morning in April. The house is quieter than it has been in 41 years of marriage. There is a chair at the kitchen table that you have stopped looking at directly. The grief is still raw. The sympathy cards are still on the counter. The casseroles people brought are still in the freezer because you have not felt like eating properly in weeks. You have handled the funeral. You have handled the insurance paperwork. You have called the Social Security Administration. You have changed the names on the utility accounts. And now, for the first time in over 4 decades, you are sitting down to file your taxes. And you have to check a different box. You are no longer married filing jointly. You are now single. You enter your pension. You enter your Social Security. You enter your IRA distributions. The income numbers are smaller than last year. Your spouse's Social Security check stopped the month after the funeral. You are bringing in less money than you were 12 months ago. And then you click Calculate. And you watch your federal tax bill jump by thousands of dollars. Not because you earned more. Not because you changed your investments. Not because anything in your financial life improved. Your taxes went up because the person you built your life with is gone. That is the widow's tax trap. And if that does not make you furious, you are not paying attention.
What I just described is not a rare edge case. It is not a glitch in the system. It is a deliberate structural feature of the Internal Revenue Code that treats the death of your spouse as a taxable event against the survivor. The IRS does not send a condolence card. It sends a higher tax bill. In the next 28 minutes, I am going to show you exactly how this works. I am going to break open the 2026 tax brackets and lay them side by side so you can see the trap with your own eyes. I am going to walk you through the 3 specific accounts that become the most dangerous financial instruments in a surviving spouse's life. And I am going to give you the step-by-step legal strategy to restructure every one of them while both of you are still alive. Because here is the truth that the financial planning industry does not want to say plainly. The window to protect your surviving spouse is open right now, today, while you are both still here. The moment the first spouse passes, most of these strategies become unavailable. Not difficult, unavailable. Let me show you the numbers first, because the numbers are what make this real. In 2026, a married couple filing jointly receives a standard deduction of $32,200. That means the first $32,200 of your retirement income is completely shielded from federal income tax before a single bracket even applies. On top of that, if both spouses are 65 or older, each spouse receives an additional standard deduction of approximately $1,600. That is another $3,200 protected. And under the One Big Beautiful Bill Act, signed into law in July of 2025, there is a brand new senior bonus deduction of $6,000 per qualifying taxpayer aged 65 or older. For a married couple where both spouses qualify, that is $12,000. Stack all of that together. $32,200 in standard deduction, $3,200 in additional senior deductions, $12,000 in senior bonus deductions. A married couple over 65 is shielding $47,400 from federal income tax before a single bracket applies.
Now watch what happens when one spouse dies. The surviving spouse files as single. The standard deduction drops from $32,200 to $16,100. Cut in half, overnight. The additional senior deduction drops from $3,200 for 2 people to approximately $2,000 for 1. The senior bonus deduction drops from $12,000 to $6,000. And here is the additional knife. That $6,000 deduction begins phasing out at $75,000 of modified adjusted gross income for a single filer. For the married couple, the phase-out did not begin until $150,000. So not only did the deduction get cut in half, the threshold at which you start losing it also got cut in half. You went from shielding $47,400 to shielding somewhere around $22,000 or $23,000 overnight because your spouse died. But that is only the deduction side. The bracket compression is where the real damage happens. Let me introduce you to Charles and Dorothy, both 73, married 46 years. Charles has a pension paying $36,000 per year. They each collect Social Security. Charles receives $28,000 annually, Dorothy receives $16,000. Between them, they have traditional IRA accounts generating required minimum distributions of approximately $30,000 per year. Combined gross household income, $110,000. That is not wealthy. That is a middle-class retired couple in 2026 who did everything right. As a married couple filing jointly in 2026, after the standard deduction of $32,200, the additional senior deductions of $3,200, and the full senior bonus deduction of $12,000, their taxable income is approximately $62,600. Under the 2026 married filing jointly brackets, the first $24,800 is taxed at 10%. The remaining $37,800 is taxed at 12%. Their total federal tax bill, approximately $7,160. Their effective rate, approximately 6.5%. They pay their property taxes. They buy their groceries. They keep the heat on. They are not comfortable in any lavish sense, but the government is not overwhelming them either.
Now, Dorothy passes away. Charles gets through the funeral. He barely gets through the first holidays alone. And then April arrives. Here is exactly what changed for Charles. Dorothy's $16,000 Social Security check is gone. The Social Security Administration eliminates the smaller of the two checks when a spouse dies. The household does not get to keep a proportional amount. The smaller check disappears entirely. Charles has now inherited Dorothy's traditional IRA. The combined balance rolls into his account. His required minimum distributions increase, not just because the balance is larger, but because the divisor from the IRS Uniform Lifetime Table is now calculated on one life expectancy instead of two. His RMDs jump from approximately $15,000 to approximately $34,000 per year. Charles's total gross income for the year Dorothy died, approximately $98,000. That is $12,000 less than the household was bringing in when Dorothy was alive. He lost income, and his taxes are about to go up dramatically. Charles files as single. His standard deduction is $16,100. His additional senior deduction is approximately $2,000. His senior bonus deduction, his modified adjusted gross income, is approximately $98,000. The phase-out for single filers begins at $75,000. He is $23,000 over the threshold. At a reduction of 6 cents per dollar over the threshold, his $6,000 senior bonus drops to approximately $4,620. His total deductions are approximately $22,720. His taxable income, approximately $75,280. Now watch the single filer brackets. The 10% bracket covers the first $12,400. The 12% bracket covers the next $37,440 up to $49,840. Everything above that is taxed at 22%. Charles has approximately $25,440 sitting in the 22% bracket. His total federal tax bill, approximately $11,100. That is nearly $4,000 more per year than when Dorothy was alive, on less income, with a grief that has not even begun to process. His effective tax rate jumped from 6.5% to over 11%. He did not get a raise. He did not sell an asset. His wife died, and the federal government responded by nearly doubling his effective tax rate. I want to stop here and ask you something directly. If you are married, have you and your spouse ever sat down and actually calculated what your federal tax bill would look like if one of you passed away tomorrow? Not guessed, not assumed, actually calculated it, side by side, on paper. Because I can tell you from everything I know about how retirees approach this, most couples have never run that number. They assume the survivor keeps filing roughly the same way. They assume the tax situation stays roughly the same. It does not. Now I need to explain the second mechanism, because the bracket compression is only the first wound. The Social Security taxation cliff is the second. When Charles and Dorothy were filing jointly, the IRS calculated what is called provisional income to determine how much of their Social Security was taxable. Provisional income is your adjusted gross income, plus any tax-exempt interest, plus 50% of your total Social Security benefits.
For a married couple filing jointly, the first $32,000 of provisional income means zero Social Security taxation. Between $32,000 and $44,000, up to 50% of benefits can be taxed. Above $44,000, up to 85%. Here is the part that has not received enough attention. Those thresholds were established in 1983 and 1993. They have never once been adjusted for inflation. In 43 years, not a single adjustment. In 1983, those numbers represented a meaningful exemption for most retirees. In 2026, they capture virtually every middle-class retiree in America. When Dorothy was alive, their provisional income was high enough that 85% of their combined Social Security was already taxable. But they were in the wide married filing jointly brackets. The deductions were large. The effective rate was manageable. Now Charles is alone. His provisional income is still well above the single filer threshold of $25,000. So 85% of his $28,000 Social Security check, $23,800, is treated as ordinary income, stacked on top of his pension and IRA distributions in single filer brackets that are half the width they were 12 months ago. The same income, the same accounts, half the brackets, twice the effective rate.
Now let me walk you through the 3 accounts that must be restructured before the first spouse passes, because after that date, these strategies are either gone or dramatically less effective. Account number 1, the traditional IRA. Every dollar inside a traditional IRA or traditional 401k is pre-tax money. You received the deduction when you contributed. The IRS deferred the tax, but the IRS did not forgive the tax. They are waiting. And when your spouse dies and you inherit their IRA, the fuse gets dramatically shorter. Here is the precise mechanism. When both spouses are alive, each person's IRA has required minimum distributions calculated using the IRS Uniform Lifetime Table, a divisor that assumes a joint life expectancy. When the first spouse dies and the survivor rolls the inherited IRA into their own account, the combined balance is now subject to RMDs based on one person's remaining life expectancy. The divisor gets smaller, the distributions get larger, and every additional dollar of forced distribution lands as ordinary income in those compressed single filer brackets. The legal strategy is systematic Roth conversions while both spouses are alive and filing married jointly. Here is how it works. You take a calculated amount out of the traditional IRA each year. You pay the tax now at the married filing jointly rate. You move that money into a Roth IRA where it grows completely tax-free, generates no required minimum distributions, and passes to your surviving spouse or beneficiaries without creating a forced income stream. In 2026, the 12% married filing jointly bracket covers taxable income up to approximately $99,680,000. After your standard deduction and senior deductions, most couples in Charles and Dorothy's income range have significant room to convert additional traditional IRA dollars at the 12% rate. The goal is not to convert everything in 1 year. The goal is a 5 to 10 year systematic conversion, draining the traditional IRA account over time so that when the first spouse passes, the survivor inherits a substantially Roth account rather than a traditional IRA bomb. Consider the specific math. If Charles and Dorothy had been converting $40,000 per year from their traditional IRAs into Roth accounts over 5 years, they would have moved $200,000 out of tax-deferred status and into permanently tax-free status. Those conversions would have been taxed at 12% in the married brackets, $24,000 in total conversion tax. That same $200,000 is now being forced out as RMDs in Charles's single filer brackets at 22%. The tax on the same money is $44,000. A difference of $20,000 on the same $200,000, simply because nobody moved it while the wider brackets were available. Account number 2, the taxable brokerage account. This account contains one of the few genuine gifts hidden inside the tax code, but only if you understand how to position it correctly before the first death. Under Internal Revenue Code Section 1014, when a person dies, the cost basis of their appreciated assets is stepped up to the fair market value on the date of death. Here's what that means in plain terms. If Dorothy purchased index fund shares 20 years ago for $20,000, and those shares are worth $120,000 when she dies, the $100,000 of capital gain that accumulated over 20 years is legally forgiven.
Charles inherits those shares with a new cost basis of $120,000. He can sell the next day and owe zero capital gains tax on $100,000 of real gains. That is not a loophole. That is federal law, Internal Revenue Code Section 1014, designed specifically to prevent surviving spouses from being destroyed by embedded capital gains accumulated over a lifetime. But here's where most families unknowingly forfeit this protection. The step-up only applies correctly depending on how the account is titled and which state you live in. In a community property state, California, Texas, Arizona, Nevada, Idaho, Louisiana, New Mexico, Washington, and Wisconsin, jointly held community property receives a full 100% step-up on both halves of the account at the first death. Both the deceased spouse's portion and the surviving spouse's portion get their basis reset to current market value. In a common law property state, which includes Ohio, Florida, New York, Georgia, Pennsylvania, and most other states, a joint account with right of survivorship only receives a 50% step-up. Only the deceased spouse's half gets the basis reset. The surviving spouse's half retains the original purchase cost. On a brokerage account with $300,000 in unrealized capital gains, the difference between a full step-up and a half step-up is a capital gains tax liability of approximately $45,000 at the federal 20% long-term rate. $45,000 that disappears or doesn't, based entirely on which state you live in and how your account is titled. The legal strategy is precise account titling reviewed by an estate planning attorney. In community property states, confirm your accounts are characterized as community property with right of survivorship, not merely as joint tenancy. In common law states, consult an attorney about retitling strategies or the use of a joint revocable trust with specific language designed to maximize the step-up available under your state's law. This is not complicated once you understand it. It is one conversation with a qualified attorney. And the cost of not having that conversation can be measured in tens of thousands of dollars of capital gains tax that your surviving spouse will pay on appreciation that should have been forgiven.
Account number 3, the joint checking and savings accounts. This is the one most families never think about because it seems so simple. Both names are on it. When one person dies, the other keeps the money. Problem solved. But the problem is not about the transfer. The problem is about what that unprotected cash means to Medicaid. If the surviving spouse eventually needs long-term care, nursing home care, memory care, assisted living, and applies for Medicaid to cover those costs, every dollar sitting in a joint checking or savings account is a countable asset. Medicaid imposes a 60-month look-back period in most states. Any transfers of assets made within the 60 months before applying can trigger a penalty period, a window during which Medicaid refuses to pay for care, even if the transfer was completely legitimate and the money is genuinely gone. An account with $150,000 in it is not a retirement cushion in a Medicaid context. It is a flashing red light to every Medicaid caseworker and nursing home billing department in the state. And beyond Medicaid, in states that participate in the Medicaid Estate Recovery Program, the state can assert a claim against the deceased recipient's estate to recover benefits paid. A joint checking account that passes directly to the surviving spouse may bypass probate, but does not bypass Medicaid recovery in every state. The legal solution is a properly drafted and funded revocable living trust, not a will. A will does not protect assets from Medicaid lookback. A will does not avoid probate. A will is a set of instructions that a probate court receives, reviews, and may or may not follow after attorneys, executors, and court costs consume between 3 and 8% of the estate's gross value. A revocable living trust holds your assets during your lifetime. You remain the trustee. You manage everything exactly as you do today. Nothing changes in how you use the assets, access the accounts, or make financial decisions. The trust is fully revocable. You can change it, amend it, or dissolve it at any time while you have legal capacity. But upon your death, the trust distributes your assets to your beneficiaries according to your precise instructions, without a single day in probate court, without court fees, without attorney fees on the estate, and without the public record exposure that probate creates. For the joint checking and savings accounts specifically, retitling them into the trust removes them from the direct probate exposure and gives you a legal structure that your estate planning attorney can design to work within your state's Medicaid rules in the most protective way available.
Now let me give you the complete 5-step legal framework. These are the actions every married couple over 60 needs to execute in 2026 while both spouses are alive. Step 1. Run the Roth conversion calculation. Calculate how much of your traditional IRA you can convert each year while staying within the 12% married filing jointly bracket. In 2026, that bracket covers taxable income up to approximately $99,680 for a married couple. After your standard deduction and senior deductions, most couples have meaningful room to convert. The target is not to convert everything at once. The target is to systematically move enough each year over 5 to 10 years so that when the first spouse passes, the survivor inherits an account structure that does not generate crushing forced income in compressed single filer brackets. Step 2. Review every brokerage account title. Determine whether you are in a community property state or a common law state. Contact your brokerage and confirm exactly how your account is titled. If you are in a common law state with joint tenancy titling, speak with an estate planning attorney about strategies available under your state's law to maximize the step-up in basis at the first death. Step 3. Establish a revocable living trust and fund it. This means retitling your home, your bank accounts, and your non-IRA investment accounts into the name of the trust. Your IRA and 401k accounts cannot be retitled into a trust while you are alive, but you can designate the trust as beneficiary in a way your attorney designs for maximum tax and Medicaid protection. Step 4. Coordinate every beneficiary designation. Your IRA beneficiary designation overrides your will and your trust. Read that again. The beneficiary form on file at your IRA custodian controls who receives that account, regardless of what your will says, regardless of what your trust says. Every retirement account, every life insurance policy, every annuity, every transfer on death designation must be reviewed and updated to align with your current intentions and your trust structure. An outdated beneficiary designation naming a former spouse, a deceased relative, or simply the estate is a guaranteed legal and tax disaster. Step 5. Model the survivor tax scenario. Sit down and actually run 2 tax returns side by side. Return 1 is married filing jointly with your current income. Return 2 is single, with the surviving spouse's projected income including inherited IRA distributions, the remaining Social Security check, and any pension survivor benefit. If the gap between those 2 tax bills is more than $3,000 per year, you are exposed. You need to accelerate your Roth conversion strategy, and you need to do it while both of you are here. I want to say something directly before we close. The One Big Beautiful Bill Act of 2025 gave American seniors a real benefit with the $6,000 Senior Bonus Deduction. That deduction helps, but it is temporary. It expires after 2028. And for a grieving widow with a pension, inherited IRA distributions, and Social Security income, the modified adjusted gross income can exceed the $75,000 single filer phase-out threshold without any unusual financial event at all. The deduction was designed to generate positive headlines. The widow's tax trap was designed to generate revenue. And the trap has been running continuously without adjustment since 1983. The financial planning industry is not going to bring this up unprompted. A fee-only fiduciary advisor who genuinely works in your interest will. A commission-based product salesperson probably will not, because the strategy that protects you most effectively is a multi-year Roth conversion plan, precise account titling, a revocable living trust, and updated beneficiary designations. That strategy generates no commissions. It requires knowledge, planning, and action while you still have both people in the marriage with full legal capacity to execute it. If you are married and over 60 and you have not modeled your survivor tax scenario, you are leaving your spouse's financial future exposed to a tax code that has been specifically calibrated to extract revenue from the year of grief onward. Tonight, not next week, tonight after dinner, open a notebook. Write down 4 things. The balance of your traditional IRA, how your brokerage account is titled and which state you live in, whether you have a revocable living trust, and who the current beneficiaries are on every retirement account you own. That is your starting point. Bring those 4 pieces of information to a fee-only fiduciary advisor or an elder law attorney and run the survivor scenario with them. The window is open. Both of you are still here. The trap cannot be fully diffused after the first spouse passes. Diffuse it now. Subscribe for a new video every Thursday. Drop a comment below. Are you currently married and over 60? Have you ever run your survivor tax scenario? Tell me what state you are in and roughly what is in your traditional IRA. I read every single one.